Hello students, welcome to my channel again. Today we are going to have a look at another very important topic in financial management. The topic name is the cost of capital. What is cost of capital and what are the components of cost of capital and what would be the benefit to the managers and financial statements or the overall as a business? That we'll have a look under this very important chapter. So cost of capital is the cost of raising and using fund for long-term source of financing. So it is a cost. Secondly, it is the minimum required rate of return that a firm must earn to satisfy all the investors' required rate of returns. Third, in economics, cost of capital is the cost of acquiring the funds required to finance the proposed investment projects. What is the importance? Let's have a look the importance of cost of capital in our business for the financial managers or the managers of company. It is very important to make investment decisions. Why? Because it is an important components to find out the net present value, future value, or internal rate of return rate, IRR rate. Without the cost of capital, we cannot find out all of these values. Secondly, capital structure decisions. An optimal capital structure minimizes the overall cost of capital and minimizes the value of the firm. If you remember, very beginning chapter, I have said that the one goal of the company is to maximize the shareholders' profit. So the efficient or optimal capital structures minimize the cost of capital or cost of the business overall. Third, dividend policy decisions. It is very important components to make decisions under the dividend payments for the shareholders. Why? Cost of capital and reinvestment rate of return is compared and appropriate dividend payment ratio is determined. If reinvestment rate of return is higher than cost of equity, companies should not pay the higher dividend. Now let's have a look the components of cost of capital. There are three components of cost of capital. The first one is cost of debt that we have already covered in previous chapter, the valuations of bond. This is exactly like that. So we just valued the value of the bond. So what is the cost of debt? It is the rate of return required by firm supplier of debt capital before tax. Cost of debt bracket KD is equal to coupon rate divided by net proceed or interest rate divided by net proceed. We need to find out that to determine the cost of debt or any kind of cost under the cost of capital point, we have to find out after tax. So this is all before tax. So finally we need to find out after tax. That is also important. Why? Under weighted average cost of capital, that the cost need to be evaluated after the cost of debt. So formula here is after tax cost of debt before tax cost of debt minus tax. So we know that the before tax is cost of debt minus cost of debt multiplied, or just let's take cost of debt common factor, 1 minus tax. Finally the cost of debt can be find out cost of debt 1 minus tax rate. Assume Sainsbury PLC can sell pound thousands face value bond with 10% coupon rate at a 10% discount rate, and underwriting of face value of is £50 will be incurred in this issue. If corporation tax is 40%, what is the after tax cost of debt? So given here is face value M is equal to £1,000, then coupon interest rate is 10% of 1000, which is 100. We can find out net proceed is equal to face value minus discount minus floating cost. So we know that face value is 1000, discount is, we know that the bond is issued in discount, it's not a premium, it's not in par value, it is issued in or it is released in 10% discount. So 10% of 1000 minus floating cost is the cost to incur, is another £50. So 1000 is £100 minus 50. So in this way 1000 minus 150, 850. Now let's calculate after tax cost of debt. We have a formula here, I divide by net proceeds. Coupon interest rate is, we know that 100, then net proceed we just calculated is 850, then we find out is 11.76%. Now let's have a look cost of redeemable debt. We know that the bond and debenture, they have a maturity date. So how do we calculate cost of redeemable debt? So we have to find out the approximate formula approach, which is before tax cost of debt. We can calculate I plus EM minus net proceeds divided by number of year divided by face value plus 2 net proceeds divided by 3, where cost of debt before tax, I is equal to coupon rate, M is equal to maturity value, and P is equal to net proceeds, and N is equal to maturity period. Let's have a look another question here. Suppose Nationwide Building Society is determining its cost of debt. The firm can issue £1,000 10 years 8% bond at £950. The flotation cost is 5%. A, it is asking what is the before tax cost of debt, and in B it asking if the tax rate is 40%, what would be the after-tax cost of debt? First of all, we know that this bond is redeemable, or it has a maturity date. So as I've just calculated here the before tax cost of debt, let's use this formula given here. We know that coupon interest is what's the percentage? 8% of £1,000, which is 80. Net proceed is selling price minus flotation cost. Selling prices, we know that it's 950. Flotation cost is the 5% of 1,000, which is £50. The net proceed is 900. So we have a formula here. Let's put this before tax. Before tax cost of debt, I is equal to coupon interest rate, which is £80, plus selling price is the selling face value is £1,000. Net profit is £900 divided by number of years. It matures in 8 years. Whole divide by face value is 1000 plus 2, net profit is 900 divided by 3. We will get the final value here, £90 divided by 933.33. In this way we will get 0.0964, which is 9.64%. This is before tax cost of debt. Now let's have a look after tax cost of debt. We know the formula: cost of debt 1 minus tax. Before tax cost of debt is 9.64, and tax is, it is saying the 40% is tax in question here, 40%. So 9.64 multiplied by 0.6, we get the final value is 5.78% after tax cost of debt. Similarly, we can calculate before tax and after tax cost of debt under the bond valuation method. What is bond valuation method? Under bond valuation method, we can find out net profit is equal to coupon interest rate multiplied by present value interest factor NUT, cost of debt, number of year, plus face value multiplied by present value interest factor, cost of debt, and number of years. Then we can calculate the appropriate before tax cost of debt is I plus M minus NP divided by 2, then whole divided by M2 and P divided by 3. Suppose a Waitrose company planning to issue 9% coupon rate bond with 20 years to maturity. The bond can be sold pound 980. Company must pay 20 pound as underwriting cost. Assume the marginal tax rate is 40%. What is the company's before and after tax cost of debt? Net proceed, as we know that 9% of 1000 multiplied by present value interest factor annuity. We know that the cost of the discounting factor, need to find out cost of debt, and number of years is 20 years, plus face value is 1000 multiplied by present value interest factor, cost of debt we don't know, and 20 years. So that's why let's find out the approximate cost of debt before tax. Cost of debt, which we can calculate as I is equal to the coupon interest rate, which is 90 pound plus face value is 1000. Net proceed we don't know. One can be sold as 4980. So this is our net proceed, 980 divide by number of years 20 years, whole divide by face value 1000 plus 2, net proceed is 980 divided by 3. In this way we get 92 divided by 97.3, which is 0.0945, that is 9.45%. This is our approximate before tax cost of debt. So now we need to use the trial and error method. So 9.45 lies between 9% and 10%. So try at 9%. Coupon interest rate is 90 pound multiplied by present value interest factor annuity is cost of debt. We are now using 9%, and in 20 years plus face value is 1000 multiplied by present value interest factor 9% with 20 years. So in this way we get 90 multiplied by the present value interest factor, we get is 9.1285 plus 1000 multiplied by 0.1784. The final value we get is 960. No, 999.97. Now we have to compare this amount with net proceed. So net proceed is equal to, we know the selling price is 980 minus 20 floating cost, in this way 960. So 99.97 is greater than 960, which is not our rate of interest. So try at 10%. So we calculate here is present value. The coupon interest rate is, we know that 90 plus 90 multiplied by present value interest factor annuity at 10%, 20 years plus face value is 1000 multiply by present value interest factor 10% and 20 years, we get 90. Again in 10% we get value is 8.5136 plus present value interest factor at 10% we get 0.1486. So the final value is 914.82, which is less than 960. So by interpolation, the actual rate of interest we can find out. Lower rate, present value lower rate minus present value TR divided by present value lower rate minus present value higher rate multiplied by higher rate minus lower rate. We know that lower rate is 9%. Present value at lower rate, which is 9%, we got 999.97. The present value TR is our the net proceed, which is 960, divided by present value lower rate again 99.97, and present value higher rate we just find out 914.82. higher rate is 10, lower rate is 9. We got 9% plus 9.47, which is before tax. So let's calculate after tax cost of debt KD 1 minus tax. Cost of debt before cost of debt is 9.47%, and tax rate is, we are given 40% here. In this way we get after tax 5.68%. Now let's have a look another topic, the cost of retained earning. The cost of retained earning we can calculate from the discounted cash flow approach. The formula for this is P0 is equal to D1 whole divided by KS minus G, where D is equal to expected year-end dividend, KS is equal to investor required rate of return, and G is equal to growth rate. KS is equal to D1 P0 plus G. Let's have a look one example here. Assume Bank of England is currently trading £80 a share. The stock is expected to pay a dividend of £5 per share at the end of the share at the end of the year, and the dividend is to grow at 5% constant rate yearly. What is the internal cost of debt of Bank of England? So we are given here growth rate is 5%, then expected dividend at end of year, which is D1 is equal to 5 pound. Then current market price P0 is equal to 80. So we can easily calculate here cost of retained earning is D1 divided by P0 plus G. D1 is, we know that, 5 pound. P0 is 80 pound. Growth rate is 5%. So we get here simply 0.0625 plus 0.05. Final value is 0.1225, that is 12.25%. Let's have a look at another approach. Another approach is called cost of new common stock or external equity. A formula is KE is equal to D1 divided by NP plus G, where KE is equal to cost of external equity, D1 is equal to expected year end DPS, dividend per share, then NP is equal to net proceeds minus flotation cost. Let's take one example here. Apple PLC's stock is currently trading at $200 per share. Company must pay 5% flotation cost for new issue. The stock pays $20 dividend per share. Stock paid $20 dividend per share last year and expected to grow at the rate 10% a year. What is the cost of external equity? So we are given here last year's dividend D0 is equal to $20, then growth rate G is equal to 10%, then expected dividend. So we get here expected dividend is equal to D0 1 plus G. D0 is $20, growth rate is 10%, so $20 multiplied by 1.1 is equal to, we get $22. Current price of stock P0 is equal to $200. We are given here is 200. Then we can calculate here net proceed is P0 minus flotation cost. P0 is $200. Flotation cost we are given here is 5%. So 5% of 200 is equal to 1 is 10. So we get value here $190. So finally we can calculate. Now we can calculate. We have got everything. D1 is 22. Net proceed is we can see here is 190, and growth rate is 10%. In this way, if we divide 22 by 190, we get 0.1158 plus 0.2 0.1. In this way we get 0.2158, that is why 21.58%. Let's have a look another topic. The topic is capital assets pricing model. We can calculate cost of capital under the CAPM method as well. We know the formula for CAPM is cash is equal to RF plus E RM minus RF multiplied by B, where cash is equal to RF is equal to risk-free rate of return, ERM is equal to market rate return, B is equal to beta or relative measure of systematic or non-diversifiable risk. Let's take one example here. Suppose Bank of Scotland has a beta of rupees 1.4 on its common stock. If the risk-free rate of return is 6% and expected return on market is 10%, calculate cost of internal equity. So given here cost of equity using CAPM, we know the formula is cash is equal to RF plus ERM minus RF multiplied by B. Risk-free rate of return here is 6%. Market return is, we are given here, the market return over here is 10%, minus risk-free is 6%, and the beta over here is 1.4 plus 4 multiplied by 1.4, we get the value of 6% plus 5.6. So in this way 11.6 is our final. Students, now let's have a look another topic is called cost of preferred stock. The cost of preferred stock as a KPS is equal to preferred stock dividend divided by selling price minus floating cost. That means dividend and preferred stock divided by net proceed. Suppose HSBC PLC planning to issue £100 par value preferred stock with 12% dividend. Selling price is 95 and floating cost is 5%. What is the cost of preferred stock? So given here, dividend per share on preferred stock is DPS is equal to 12% of 100, which is 100, 12% which is 12. Then net proceed is equal to selling price minus floating cost. So selling price is, currently we are selling 95 pound and floating cost is 5% of 100, so 95 minus 5 we get 90 pound. Then we have a formula here. Cost of preferred stock is KPS is equal to DPS divided by net proceed, which is DPS is 12 pound and net proceed is 90 pounds. So in this way we get 0.1330 of 13.3% of. Students, now let's have a look the final chapter, a final point, which is known as weighted average cost of capital. What is weighted average cost of capital, or WACC? It is the compositions of WACC is the weighted average of after-tax cost of debt, preferred stock and common stock. So the formula is WACC is equal to KDT multiply WD plus KPS multiply by WPS plus KS multiply by WS plus KE multiply by WE, where WD is equal to weight of debt, weight of debt, KD is equal to cost of debt, KPS is equal to cost of preferred stock, WPS is equal to weight of preferred stock, KS is equal to cost of retained earning, WE is equal to weight of external equity, and KE is equal to cost of new equity. Now let's have a look one practical example here. Suppose Samsung PLC's cost of equity is 14%, its before tax cost of debt is 10%, it can issue 12% preference share at par, company's marginal tax rate is 40%, and its balance sheet is is as follows. The balance sheet, the assets is showing the current assets of rupees current assets of $400,000 and fixed assets is 600,000. Liabilities, debt 400,000, preferred stock 100,000 and common stock 500,000, total 10,000. So calculate company's weighted average cost of capital. So cost of debt is equal to before tax cost of debt is equal to 10%. So let's calculate after tax cost of capital is equal to cost of debt 1 minus tax. Cost of debt is 10%. Tax rate is, we know that it's 40%. So 10 multiplied by 6 is equal to 0.06, that is 6%. And cost of preferred stock, cost of preferred stock 12%. Then cost of common stock equity, which is 14%. So let's calculate now. WACC as follows. So we are given here source of fund is debt, a preferred stock, and common stock. What is the value? Amount in dollar is, debt is given as 400,000, preferred stock is 100,000, then common stock is 500,000. Total is 1 million. And now let's have a look its weight. How do we find out the weight? You just divide each value by total value, then you get 0.4. You get 0.1, then 500,000 divided by 1 million is 0.5. If you add it, it will give you 1 total. Now let's calculate after tax component cost. For common for after tax cost of capital, cost of debt is equal to 6%. Then for preferred stock is 12%. Then for cost of common stock is 14%. Now let's make another column. Weight multiply by after tax component costs. So we simply calculate 0.4 multiplied by 6% is 2.4%. 0.1 multiplied by 12, which is 1.2%, and 0.5 multiplied by 14 is equal to 7%. Then we get the final value. Weighted average cost of capital is just 8 of these: 7, 8, 9, 10, 10.6%. Alternatively, we can calculate WACC as cost of debt is equal to weight of debt plus cost of equity is equal to weight of equity plus cost of preferred share multiplied by weight of preferred share. Cost of debt is equal to 6% plus weight of debt is 4 plus cost of equity is 12% multiplied by 0.1 plus cost of preferred share is 14% multiplied by 0.5. In this way we would get the same result as 10.6%.